market maker model, like how to use it, stuff like that. Like what's the easiest way to like guarantee success with the buy and sell list?
You're
Like
coming in and out
uh uh still coming in and out or
a
no?
little bit.
Right. Okay. Well, I'll speak louder. The noise suppression thing is on, but might just be bandwidth thing. So yeah, like when we look at like the market maker model as an example, right? Um, like you get this list, and like I know like other platforms they give you like an entire like list of things. They say like you can filter by everything you want to filter by and all that sort of jazz. But like personal opinion, like from like our perspective and like what our motto is like back like did you backtest is basically our motto, right? Like, did you backtest? You can get all of these tools that give you like gamma levels, that give you flow, all that crap, but like they just haven't backtested any of it. Um, it they're relying on other people to give you information, and like the thing with all of this stuff is like everyone has their own calculation. Some people's are like worse than others. Some people like do a better job of it, and like with us, obviously being biased here, like I've back tested our gamma levels. Like we have like the mean return on like a gamma level being like 17 points if it's a long or a short. It doesn't really vary, and it's played out time and time again. So like I mean, Aman, you've been here a while now. You can kind of attest to it. Vo, you've been here a while as well. um think you guys have like seen it play out a bunch of times now where like those numbers that we like mention on a back test, they just land, right? Like we had what was it? 3758 today on ES. And we bounced directly at that level and we pushed up to was it 3772? And that's pretty much like in line with positioning, and then we also didn't just like land 3772, we then pushed up a bit higher, which I think was to around 3775, which is that 17-point sweet spot. If you look at ES, basically at the open, today being the 5th of October, um, we then basically pulled down directly from that point, right? So like that's kind of like where we separate ourselves from everyone else, and like what we like try our best to do in terms of like giving you data, fine, but like all anyone ever really cares about is returns and what's my likelihood of success. Because like you trading is like flipping a coin, right? Like you have a distribution of returns, um like uh and it's either going to be like success or fail, and then like using that like in your mind you can then begin to like adjust size and so on, like assuming like if this is a low probability setup, I'm not gonna be aggressive in sizing. Like I'll take it down. Maybe I trade 5 lots on average usually, or like my range is 1 to 10 lots, right? If I'm gonna trade 10 lots, I'm only gonna do 10 lots when everything aligns and I've got like a super high probability of success. Because then like even if I do take a loss on those high probability setups, I'm only gonna take a loss say like 1 out of 10 times, if it's like a 90% probability of hit, right? And then if even if it's like 70%, I'm only going to lose 3 out of 10 times, and I'm willing to lose that because if I repeat that same setup 7 out of 10 times, in theory, I will land 7 times, and that will way outstrip my losses. Um, Seems simple, but it's harder to implement like when trading live. So like using the same concept, you can do the same stuff with the market maker model, right? Um, so this was XOP as of the 30th of September. We posted that back then. It was a buy price. Spot price was 124. If we take a look now at XOP right now, see that's like a couple days later, the price now is 142, right? That is about a, what, 124 to 142 is 18. So you're looking at about a 15% return in the space of 5 days, which is insane. Like, was pretty good going. Like, but we also know like what the mean returns are from the market maker model, which is like on a 5 day basis, you can expect a range of like sort of around 6% as like a base sort of average, 6 to 7% as an average, to like a, at the peaks we've seen returns of like 55%, but that's mainly been on um, super high beta like meme stock type names, like BBIG was an example, where we had a buy on that a while back. But then like how do you identify like out of all these buys like which one is like got the higher probability of success? Well, you can see the spot price here, and you can see like the peak negative position. Like anything that is below peak negative positioning is going to give you a higher result or probability of success simply because of the mechanics, right? Like if you look at our our positioning, and this is going to be unique to us because like we have our own models and our own heuristics that define what is on the market maker's portfolio. Like we don't use a naive calculation. We use our own heuristics to identify when a market maker is buying and when a market maker is selling a certain call or put. And like using that, you can then basically identify that, okay, assuming the market maker is short puts, because we essentially look at everything on like a participant basis, and we try and identify what the participant is the buyer of, and then we reflect that in our market maker levels. Um, Here you'd see that, okay, market makers are basically short 125s on puts. Using that ideology, we can then essentially apply this concept here, which says, right, we're at 124.72 on spot price, peak negative gamma is 125, we're below that, people who are holding that position currently right now are in the money. They're not likely to just hold it, right? Like they either roll down the position, and then you would see the next day if the position has rolled down or not, because the peak negative positioning is available to you. If that's not the case, then the likely scenario is they start to roll that off. When they roll it off, if it's a large position, which I mean, like this is looking at every single expiry, all tenors available, and then identifying like what's the max and what's the minimum, right? Like what's the max put position that all participants are on, and what's the max call position that all participants are on. And you can see here then like using that concept, when they sell those puts, market makers who are selling to hedge those put positions are then going to unwind that position alongside the participant who is winding them up. So like just reiterating it again, I've reiterated it before, when someone is short a position, a market maker is short a position, they're short a position because they're trading with the participant. They just care about selling risk premium. They don't care about the rest of the stuff. Like they, all they want to know is like, okay, I want to sell this option. I want to bake enough premium into this option to make it profitable for me. And then I also want to protect myself against downside or upside if it's going against me, right? Because they'll have models that basically predict realized vol, and using that concept, they can then use that to price their options, because then that will give them an idea of like what the move is likely to be, and then what's the probability of that option going in the money, and then they price accordingly. So that was a great one. That was a really good example of the market maker model. Um, Apple here was another one,
Jay,
right?
Dr. Jarvis, can I ask a quick question?
Yeah, sure, go for it.
Is this run against the same subset or universe of stocks and ETFs? Uh, can you describe that as like 500 or 1,000 or 300?
What do you mean? Oh, is it sort of run against like the same? same list of tickers like all the time.
Right, right.
Yeah,
So like lately, until just recently, it mostly had buys, was skewed to the buy side.
yeah,
And is the universe constant? Is your select universe that you run this against constant?
yeah. So like the great thing about this is it's not it's not dependent on other tickers. Each position that's posted is related to that ticker alone. So the reason for that is like if I didn't do that, then like it would just skew results. So like I'm looking at how a market maker is positioned for said ticker, and
So
then
this, let me say it differently. Is this like the top 25 maximum or something?
no, 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 not even that is going to give you every ticker that pops up like through the neural net that says this should be a buy and this should be a sell.
Oh, so you don't limit it
Yeah,
could be, it could
it
get
could be
much longer.
hundreds. Yeah, it could be hundreds. It could be 200. It could be like any
Oh,
number. Uh, Anything that meets the model's like idea of what should be a buy or sell is going to pop up.
cool.
So like, there's been
Can I ask you two questions
yeah, sure, go
on
for
that
it.
list? So how do you interpret, like, looking at that list, and then you were excited about Palo Alto Networks, but looking at it, the peak negative gamma was at 130. The spot price was so far away from the deltas,
Yeah,
gammas, which was
yeah,
different than like XOP.
yeah,
And so I was trying to understand.
yeah. So Palo Alto was like, so with Palo Alto, I used a bit of discretion with that one in particular. It didn't like follow the standard like set of rules, um, and then as a result, like I mean, its move wasn't anywhere near as aggressive as say like XOP's was, right? Obviously, you
Yeah.
got to account for other things that are unique to each stock as well, because each stock will have its own defined movement pattern, and then that becomes reinforcing on its own because models and algos, like given the market is run like 80% algo in terms of volume at the moment, from like the recent stats that I have off the top of my head, they're going to move like in relation to like how historical moves have been, right? Bar like outlier events where like there's been a huge catalyst, like a major earnings or like some regulation that's been passed through or something like that, right? So that would be unique to each stock. 'Cause, like if a like a GameStop moves like 5-10% in a day is going to be very different to like an Apple, which will move on average maybe like a percent a day, but then in like a bear market is likely to move like 2% either or positive or negative, right? Palo Alto Networks I looked at and was like excited about that one, mainly because of like discretion. So I was looking at um, volume profile and like where volume was like aggregating uh, on that particular one, and that's why I was interested in Palo Alto as an example. So like it didn't fit like the standard ruling, but it it matched from like a volume profile perspective, and then it also matched from like a narrative perspective. So we had like the Uber hack recently, and then we also had like these recent events with like the Ukrainian situation where Putin's like been escalating his verbal threats, especially like the nuclear action that he's been like threatening recently, right? And like I know firsthand that cyber since that event has started has moved in line with defense stocks like LMT, knock, so on. So that's why I was interested in that. And when it popped up on here, then I was like, okay, well, market maker model saying buy. I'm
I guess
interested in this as well.
can you break down? I mean, this might be a really dumb question, but in most of them, the spot price is typically. It seems to me like the ones that have been best to play have been where the spot price is near like big negative
Yeah, yeah, yeah,
gamma.
yeah, exactly. Yeah. So like Apple was
And
one.
so, yeah, so I guess I'm trying to understand, given that, like, using the model and not your discretion, what is the model saying on Palo Alto networks? Because that one
Yeah,
didn't
so
really.
yeah, so like it doesn't match like the typical like rule of thumb that I've looked at and also like tested to like give the most torque. But basically the model runs on a neural net. It looks at all the Greeks like Varna, Gamma, Delta, Vega, um, and then combines it all, basically creates a view of like a this is likely to yield a positive return on this direction. So like Palo Alto didn't match like from like the rule of thumb in terms of peak negative below or like if it was on sell above peak positive type thing. Um, that is definitely like more of an outlier. But like if it's on the list, it's likely to have a positive return just based on like the stats, which is like a
And,
70-ish% hit rate. I just look for
and
like, okay, if I'm
so,
looking at these are the ones that I'd like have more confidence in if I'm just using like rule of thumb type
right.
concept. Because you've got like, I mean, if, and I've had one sub ask me about this already, right? Like they wanted to use this model to like build a long short portfolio and then change uh, as time goes on. I was like, well, if you're gonna do that, like there's just too many tickers for you to do that unless you have like a large account. Because I mean, a lot of funds who trade in this way, like they've got the credit lines that they need to trade all of these pairs simultaneously with the right amount of size to then yield the number of hits that they can to make them profitable. Obviously, like for a lot of retail people, like we just don't have the size available to us to do that. So you got to kind of like hone it down, and we're making more improvements to this to give things like confidence intervals and so on to give you an idea of like okay, probability of success for this ticker, and then also like
Okay.
where the
And then
expected
what are you
returns.
using as like the exit price?
Yeah, so exit price, like I mean, I typically like aim for where the peak positive position is. If you're using the dashboard though, which is like what I also recommend, in the dashboard you have a view of the cumulative, well, it's a cumulative distribution of returns both on the daily and on the weekly, right? And that's giving you an idea of like close to close, where does that stock usually return? So like I put a tweet out recently talking about SPY and saying like given the move, a pullback is likely because of like how far we moved and how fast. So week to week, SPY doesn't have returns that are above 6% in general. Like it's less than a 1% chance that that's going to be the case. So if that is the case, there's got to be a pretty good reason why. If you can't justify that, then it's likely to become a mean reverting process. Um, so that distribution of returns gives you like a way to like think about this stuff on like a probability basis and then identify like okay, I know that this is going to move from like on a typical day between like the I don't know like 20% mark to like the 80% mark. So like 60% of returns are going to be between here. So that's roughly about the standard variation of returns for that stock, right? With that concept in mind, I can then say, okay, I I'm gonna aim for around that mark in terms of like the returns that I'm looking for, whether it's positive or negative, like as in short for negative and long for positive.
Okay, thank you.
Um, so yeah, that's basically like an example of using this, and like this was like a really good week for most of the subs. This time around, like the tools like really like came into play. So we had Apple at 138, Microsoft at 232. That also went much higher as well. What was Microsoft? Let me check that. So Microsoft is now at 248 at close. That was an example. Hit a high of 250. If you look at Microsoft, it had that peak negative position at 250, and that's where it kind of like stalled out. But that was another one that you could have looked at and seen from like its distribution of returns that uh, it was basically like nearing the edge of what is normal. And then I think another one was Netflix. What was that like? Let me bring that one up. Maybe that wasn't a good one. I'm not sure. So that's 235. It had a really bad day today, so like knocked it down a bit, but it still closed positive. Even if you held this entire time, it's at 236. Prior to that, though, it hit a high of like 245. So that was another one that was also pretty good. And then prior to that, there was another buy on Netflix where it moved like 8% during the day. Like it was a definite leader amongst big tech. And then yeah, with like looking at the banks, it goes without saying, names that don't move that aggressively moved extremely aggressively today. Like Goldman Sachs blew out its distribution of returns, as did Morgan Stanley. So and XLE was another one as well actually. They all like moved way out of line. And what was super interesting was how positioning here like came ahead of like the narrative that came out today with OPEC basically saying we're going to limit the amount of oil that we're producing. Like I'm no oil expert, but like I'm a definite believer in like time series can be like used to identify and predict movements. Like we do it all the time across various fields. It's just the market is like typically harder to do it across because it's full of randomness. Cool. So I'm gonna close the recording for this one for the market maker model, and then we'll go into some other stuff. So just give me a second. And actually, yeah, just before like, what's worthwhile mentioning is like TLT popped up on sale. That also sold off during this week. It was actually like a lot weaker versus other tickers. So what was that? 102. Let me see if that was a good example. But I remember from today it was like fairly weak. Okay, yeah, that one wasn't amazing actually because that came at 102, but we closed at 102.65. But it did have a look down below at like 101 point something. But yeah, okay, cool. I'm gonna close this one down. So if you guys do want to take a look at it again, feel free to look at the YouTube channel. I'll be uploading this tonight. All right.